Welcome back to FX Titan. Imagine planning a road trip. You need a map, a budget, and the patience to handle detours. Trading is no different. In today's video, we explore basic technical analysis and market phases, how to manage risk and control your mindset. We're also going to talk about why we don't do overtrading, revenge trading, fear of missing out or FOMO, and your worst enemies. So you buckle up, it's going to be an exciting ride. Think of the market like a roller coaster. The impulsive phase is the trailing climb or drop. The market moves quickly in one direction, driven by strong momentum. Whereas the corrective phase is the slow, winding turn, where the market takes a breather, moves sideways or slightly in the opposite direction. Just like on a roller coaster, you need to anticipate the twists and turns to stay ahead in trading. Recognizing these phases can help you decide when to enter or exit the market. Fundamental and technical analysis are like baking a cake. Fundamentals are the ingredients: economic reports, interest rates, inflation, unemployment, news events. They provide the substance behind the market movement. Whereas technical analysis has to do with the recipe. So you need both the ingredients and the recipe, how to mix the ingredients, to figure out how to analyze charts, patterns, and indicators in order to determine the market direction. So just like you can't bake a good cake without both ingredients and a recipe, you need both analysis to informed trading decisions. Trading is not a get-rich-quick scheme. It's like farming. You plant the seed. Your trades, water them with patience, and wait for the harvest, profits. Unrealistic expectations, like trying to double your account overnight, are the fastest way to disappointment. A patient and disciplined mindset is your best friend in trading. Risk management is like carrying an umbrella on a cloudy day. You can't control the weather, but you can protect yourself from getting soaked. Only risk a small percentage of your account per trade, 1 to 2%. Use stop loss order to limit potential losses. Avoid putting all your capital into a single. Your goal is capital preservation. Stay in the game long enough so you can see it is better to be and remain in the game long enough to see success than to lose your account. A trading plan is like a grocery shopping list. So if you stick to it, you avoid unnecessary purchases. So you stick to a trading plan. Unnecessary purchases such as candy, sweets, the rest of them don't come into play. Your plan should include your trading goals. How much do you want to, by what percentage you want to grow your account a day or in that hour, that particular time? Your risk tolerance. How much are you willing to risk? How much of your account? 1%, 2%? The entry and exit rules. Where do you get to where you know that you cannot continue with the market again and have to exit? And where should you enter? The checklist for each trade. Impulse trade are like grabbing chips and candy you didn't need or you don't plan to buy. Mess up your budget. Results at the end of the day. To tip the scale in your favor, you need to treat trading Forex like a sport. You practice with a demo account. Let's say you are practicing soccer or football. There's a lot of practice that you need to do to get some certain kicks, some certain shots, targets. You need to review your trades to learn from mistakes. So once a particular trade goes whether in your direction or bias or not against you, you need to review this trade. Learn from it. What are the patterns that you missed? What went wrong? Now you also need to stick to your strategies with a proven edge. Consistency and preparation are what turns amateurs into pros. Overtrading and over-leverage are like overloading your plates with a buffet. You think you can handle it, but it leaves you feeling awful. Overtrading happens when you trade too frequently without proper setup, chasing the market instead of waiting for it. Over-leverage magnifies your trade, but also it magnifies your losses. And let's talk about FOMO, fear of missing out. It's like rushing to a party you weren't invited to, only to find out it wasn't worth it. Avoid trading based on emotions. Revenge trading It's like trying to fix a bad haircut yourself. You are emotional and make things worse at the end of the day. After a loss, take a step back, analyze what went wrong, and move on. Ignoring the psychological aspect of trading can lead to poor decision making. Stay calm, stay focused, and remember, the market isn't out to get you, it's just doing its thing. Now, to wrap it all up, I'm going to go through all that we have covered. We've covered the market phases, different phases that we have in the market. We also cover how to blend fundamental and technical analysis, just like the analogy of making a cake, both with the ingredients in the recipe. We looked into risk management. What is the proper risk you should take on your account? And essentially, we covered what we mean by trading plan, working with a particular plan, analyzing the market at the end of the trade, and the dangers of overtrading and emotional trading discussed extensively, where we spoke about the fear of missing out, revenge trading, the likes. Trading is a journey, not a sprint. With the right mindset and tools, you can succeed. If this video helped you, give it a thumbs up, subscribe to FX Titan, and turn on notification for the next lesson. Got questions? Drop them in the comments. Here to help you.